Good afternoon. Welcome to Midcap Radar here on CNBC-TV18. I'm Hormuz Fatakia. With me is Vivek Iyer. Vivek, there and thereabouts for the Nifty, almost nearing a record high. It's the start of an expiry week, so there is a lot to catch up on.
And very positive commentary coming in from overnight. Qs looking very positive. We started off higher, above the 25,000 mark as far as the Nifty is concerned, and the mid-cap and small-cap index also trading the gain. So nothing much to complain about, doing very well. But quite a lot lined up in today's show. Let's start off with the top headline. US Federal Reserve Chairman Jerome Powell sparks an equity rally with his comments at the Jackson Hole Symposium, suggesting rate cuts ahead. IT and consumer durables are the big gainers, even as capital goods and realty lag. Mid-caps relatively underperform.
IT stocks are among the top gainers today on hopes of a rate-cutting cycle beginning in the United States.
Zydus Life Sciences tips after global peer Teva gets a nod from the US FDA to launch a generic that it was the sole supplier of earlier. The promising acquisition as well of a 50% stake in Sterling Biotech fails to offset this concern.
Now, shares of MedPlus have recovered in trade today and are now over 3% now after a big block deal that saw nearly 13% equity change hands at 616 rupees a share.
Shares of NIIT are locked in an upper circuit of 20% after veteran investor Ramesh Damani emerges as one of the buyers in the block that took place on Friday. Damani acquired 8 lakh shares of 0.6% equity at an average price of 127.5 rupees a share.
As we just mentioned, it's there and thereabouts for the Nifty, but still struggling to get to that record high level of 25,078, remaining hovering around that mark of 25,000 near the highest point of the day and continuing to remain where it was through most parts of the first half of the trading session. Now 0.8% higher for the Nifty, but can't really complain because this is the 8th day of gains for the index. So it's doing fairly well. From the budget day low that we had of around 21,280, the index is up almost 4,000 points in just a month. Shows you the kind of recovery that we have had. For the Nifty Bank also was down almost 600 points for the series as of closing on Friday. It has recovered some bits of that, up nearly to almost 270 points now, slightly off the highs of the day, but remaining around above that mark of 51,200, which is a key level to watch out for. The broader markets, though, they are continuing to do well, but the rate sensitives are actually the ones that are doing very well in today's session, be it IT, be it metals, be it realty. They are the ones that are outperforming in today's session, Vivek.
Absolutely right. Rate sensitives, that was what I was getting to as well. Real estate, in fact, today we've spoken about IT in depth, but real estate, some of the names like Oberoi Realty, DLF, some of the other names too, as far as the real estate pack, were doing quite well. The other pocket of the market that's doing quite well are the oil refiners. Have a look at Reliance. Even if you pull up a 5-day chart ahead of its AGM, this particular stock was outperforming. In the last hour and a half, you've also seen quite a bit of buying emerge as far as ONGC is concerned. That stock too trading near the day's highest point. But this particular show is Midcap Radar. This is a special segment, Midcap Movers. Vamakshi today is at the wall to take us through all of the midcaps that are moving around in the session.
Well, absolutely, Vivek. There's no complaining here. It's green across the screen, but it is the benchmark indices which are outshining the gains in the mid-cap index. But nevertheless, the mid-cap index does have its share of gainers. We first have Kalyan Jewellers, which has surged by almost 6% in the trading session today. Tata Elixir, M&M Financial and Macrotech Developers have also surged over 3%. And in fact, when we look at some of the top losers this time around, not much, but still, we're seeing some downtick as far as Torrent Power, GE Shipping, Reddington and Raymond is concerned. IT stocks have gained in the trading session today after Fed Chair Powell says that it is now time to adjust the policies. Resultantly, we're seeing some big moves on Birlasoft, which is up nearly 5%. Tata Elixir, like I mentioned before, is up nearly 3.7%, and Cyient and Emphasis are also up in the trading session today. But apart from that, there are some big moves coming on the back of strong volumes as well. Honasa is up nearly 12% in the trading session today. In fact, earlier today, it hit an all-time high after NCLT Nord came in for Just for Kids, Fusion Cosmeceutics merger as well. KEC is also up nearly 3%, and that is because the company has won orders worth 1,079 crores. And lastly, Bansal Wires is up nearly 6%, and that is because Investec has a buy call. 25% potential upside is what they see.
Plenty of movers in the broader markets. Vamakshi, thanks a lot for joining in with those. But one particular stock that I wanted to highlight is NIIT, and that is locked in a 20% upper circuit, as Vivek just mentioned about Ramesh Damani acquiring stake in the company. So on a 20% upper circuit is NIIT at 153. Good time to get in. Dharmesh Shah of ICICI Securities for a quick chart check on the markets. Dharmesh, good afternoon. Thank you so much for joining in. Well, it's expiry week for the Nifty. There has been a lot of positive commentary that has come in from the globe. But do you think this expiry related volatility will keep the upsides on the index in check, at least for this week?
Yeah, good afternoon. Yes, definitely. I think the week started with a very optimistic note. We see on the back of strong global news, we see a gap up for the market. We believe yes, this momentum should continue for the Nifty, and we should be looking for a target of 25,400 in the coming week. So yes, the buy the dip should be the strategy. And if you look at the market breadth, I think it's a good indicator judge the sentiment, where the percentage of stock in 50-day moving average has improved from 40% to 60% of CNX 500. So it's clearly showing it's a broad-based buying happening right now. And we expect this momentum to continue towards 25,400 with strong support at 23,700.
Dharmesh, good afternoon, and thank you so much for joining us. What are the individual stocks on your radar today? What is it that you're recommending?
Yes, as far as stocks are concerned, we remain to be positive for oil and gas as a sector as a whole. Yes, sector has been clearly a relatively outperformer in this current corrective phase from where you see from 25,000 to 24,000 for Nifty. But we believe, I think, that this sector should continue this positive momentum going forward, where Gas Authority of India again remains to be a top pick. Again, the stock from a bigger picture, a long middle breakout, and post earnings, I think, so we see a GAIL trading this narrow range of 15 to 30. We believe, I think, so GAIL should be look for a target of around 278 in a stock price of 224. Apart from GAIL, we remain to be positive for insurance sector as a whole. Again, this sector was not in limelight for a long time, a long consolidation breakout happening for most of these insurance stocks. We remain to be positive for HDFC Life. Again, the stock since for last 3 years has been into more of a corrective phase and has been witnessing a falling channel breakout. The end of the corrective phase for HDFC Life, and we should be looking for a target of around 798 to 800, giving a stop loss of around 654. So HDFC Life and Gas Authority of India should be at top.
Thank you. Thank you so much for joining us, Dharmesh. We seem to have had you on a bit of a scratchy line, but GAIL and HDFC Life were the two stocks that you mentioned. Let's now slip into a short break. When we return, we will be joined by Ghulam Zia of Knight Frank India to discuss the recent report on growth in prime residential prices. Welcome back to Midcap Radar. Well, one particular sector or segment of the market that's done very well, especially in the last year and a half, has been the realty pack. When you're looking at stock prices, number one, a lot of these stocks have given very significantly higher returns. Have a look at the one-year chart of names like, let's say, a DLF, an Oberoi Realty, a Godrej Properties. All of these stocks have given significant returns. In this context, and also in the context where we try and understand how exactly to look at prices, both on-ground prices for real estate in some of the top-tier cities, we have today Ghulam Zia of Knight Frank. They've come out with a very interesting report which reveals that Mumbai has recorded the second highest annual price growth in the world for prime residential properties in Q2 2024. Good afternoon, Ghulam. Thank you so much for joining us. First up, Mumbai, not very surprisingly, tops the chart as far as price increases are concerned. What's driving the significant increase as far as on-ground real estate prices are concerned? Is it demand or is it more of a lack of supply?
Well, to start with, let's look at this phenomenal increase, like 13% on a year is a huge number when we're talking about Mumbai, or even if it is Delhi, 10.5% odd. The reason, your question is about how do you justify this? Well, I would still not talk about lack of supply. I would rather talk about abundance of wealth creation. The ability of buyers to go out and buy these luxury properties is what is keeping the luxury market or the prime residential, not just in India, but all over the world, on the boil. Everybody is out there to buy. So net, the reason is simple. It's not so much of a lack of supply, but abundance of wealth, which is driving the prices so high.
You know, Gulam, you may complain all you want about the civic amenities that you get in the most of these metro cities, but prices are shooting through the roof. But as you mentioned in your survey as well, right, demand in the premium pricing category has been the one that has been driving this pricing growth. Do you see that trend of premium pricing continuing to drive sales going forward? And what is the pecking order in terms of driving sales, be it premium, then mid pricing, and then entry level? Or does entry level has seen some bit of improvement compared to when we last spoke?
Okay, let's put the picture straight here. The index that we are talking about is the prime property index alone. And in every of the 44 cities across the world that we map, we only take the luxury project in each of these cities and measure their performances. And the index that we're talking about is just that. Since your question is larger, you're talking about the whole market, mid and lower end. That is not a part of this study, but since the question is that how are they performing, let me tell you, there is not much of a growth in the lowest end of the market. In fact, lowest end, the affordable housing has been suffering consecutively for last 4 odd years. And that fatigue is unfortunately seemingly creeping into even the mid segment, which is worrisome. And let's also, since we're talking about the prime properties globally, let's also look at the last 1 quarter. The 13.5% or 10.5% that we're talking as far as Mumbai and Delhi, standing at place number 2 and 3 respectively, just after Manila, where it is 26%. That also, if you look at only the last quarter, not just in Mumbai, Delhi, but all over the world, last quarter has been a drag. It's been very low. I think 2.5 to 2.3% is roughly the growth all over of those 44 cities. And that even Mumbai and Delhi are also not different. Like Mumbai has seen barely 2.6% growth in last quarter. If you compare it with the annual growth of 13.5%, that means there is a slowdown. On the other side, Delhi is at 0.1%, Bangalore at negative 0.1% the last quarter, which is showing that even the super luxury, the upper end, the uber prime properties are also showing some drags. Some amount of fatigue is coming in. But definitely to close, the lowest end is in not really improving at all. The mid end is also showing sign of fatigue. That is a big concern.
Gulam, very, very interesting point that you've put out there. You know, Mumbai ranks 2, Delhi ranks 3, Bangalore ranks 15th on this particular index that you're talking about. So the premium end of the market doing quite well. Some amount of exhaustion is what you've seen in the last month. Now, give us a sense of, especially if we were to forecast demand going forward, in the backdrop of likely rate cuts, how exactly do you see demand panning out? Is it elastic or is it largely inelastic, especially in the premium end of the market?
Well, at least the premium end is still not showing any sign of reduction in velocity of sales or number of transactions that are transpiring month on month for last almost about 2.5, 3 odd years. And that is something which is giving us a little confidence that even in short term, we don't really expect this to turn so drastically so soon. As I said, even the mid-term market, the mid-end market was also doing exceedingly well for same kind of period, but right now showing some fatigue, signs of fatigue. But as far as super luxury, the upper end of the market is concerned, the number of transactions that we see in, say, Mumbai or a few projects in Delhi, Gurugram or Bengaluru, these are locations where the transactions in the upper end of the market is still not showing any signs of reduction. So that gives us comfort to say that if I have to talk about some amount of crystal ball gazing, at least next quarter or 2 at least, the upper end of the market is not going to be changing so drastically. Mid-end point of concern arising, lower end continues to be a big concern. And as you rightly said, the reason is simple. The central banks have to now, if at all real estate is their priority, they have to consider rate cuts now. Otherwise, it will be reflecting on real estate sector as well.
You spoke of exhaustion, Gulam, and I wanted to ask you this, that you mentioned for a quarter or 2 at least the premium market will continue to grow the way it is, even if there is a slight slowdown. But there will come a point, right, if the prices keep going up the way they are, that there will be buyers who would put their hand up and say, okay, even if we are capable of buying this, we are not going to buy it because the prices are just too high. And even if there are divergent opinions on this, but still for most Indians, real estate is still considered an investment opportunity and not just something that you reside in and things like that. So do you see that bit of exhaustion or a bit of a decline coming into the premium end of the market? Because the lower end is already suffering, but do you see that happening in the premium end as well if prices keep going up?
Well, price continuously going up will definitely be a problem. Whether it is taken as an investment class or not, that the point have gone beyond anybody's comprehension will be a pain point, and which is true for the whole market, not just the premium segment, but mid to lower end. Of course, the lowest end is the most susceptible to a price rise continuously seen. In fact, that's where the price rise is not as much. In the upper end, the price rise is high. Let me also bring in another aspect that as far as upper end is concerned, the buying of property is not so much to do with investment as well as return on investment, as well as the investment of passion. So when you're buying an absolute upper end property, like for example, if you're buying something in Gurgaon, these days it's showing a lot of such projects where more than 100,000 rupees a square feet product you're buying, or in Mumbai where it is 150,000 rupees a product, a square feet of product, you're obviously not expecting these prices to double up in next 4 to 5 years or even 10 years. So the rate growth in the upper end of the market is not expected to be that high. But you're right that if the prices continue to rise as much as they are, say 13.5% that we saw in last 1 year in Mumbai, it's a big sign of concern.
Ghulam, thank you so much for joining us, and thank you so much, for helping us break down and understand what exactly is going up, especially in the upper end or in the premium end as far as the real estate market is concerned. Let's now slip into a short break. We'll get you more on the markets and stock specific action on the other side. Stay tuned.
Back with us here on Midcap Radar. Now in our special segment, Midcap Spotlight, Nigel is joining us today to focus on Bansal Wire Industries, which is surging in trade after Investec initiated coverage with a buy rating. Nigel.
Well, that's right. Investec has made a few crisp points out here. Keep in mind, this is the newly listed company, Bansal Wires. Now, they have initiated coverage with a buy rating and the target price is around 440 rupees per share. They are saying that the company has created a niche for itself in the commoditized steel and stainless steel wire market. They also go out to say that they have been, offering a wide range of products and also reducing the concentration risk with regard to customers, which is important. They have undertaken 2 initiatives, and Investec believes that this will hold them in good stead because these segments are more profitable. They have named 2 of them as they're foraying into steel cords as well as backward integration into the stainless steel cords. So backward integration as well as a new foray, they say that this will help their profitability going ahead. And that's why they're seeing a 40% EBITDA CAGR over the next few years. That's between 2024 and 2027 with high teens ROCE. They've also gone on to say that valuations at around 24 times, well, it's not very, very expensive and they look undemanding. So that's why Investec is positive on them. Valuations undemanding. They like the way the company has diversified itself, and also the foray into 2 new lines is going to hold their profitability in good stead. Back to you.
Thank you so much, Nigel. Stock high by almost 6% in the session today. The next stock on our radar is Emcure Pharma. The stock is also trading with gains as Jefferies has initiated coverage on the stock. Ekta joins us to tell us more.
Well, yes, Jefferies has initiated coverage on Emcure with a buy and a target price of 1,600. They believe there are key differentiators for Emcure: strong chemistry skills in complex molecules, no exposure to the volatile US markets. Following should benefit Emcure in the near term, which is basically high growth in India and Canada, operating leverage, debt reduction. They estimate 11% revenue CAGR from market share gains in India, new launches in exports, and estimate a profit of 29% CAGR FY24 to 27, led by 2.2% EBITDA margin expansion and lower finance cost.
From one listed company to another, a newly listed company, Emcure Pharma. Ekta, thanks a lot for that. Already up almost 40% from its IPO price. So positive commentary coming in on both Bansal Wires as well as Emcure Pharma. But the latest happenings in the Religare case now, and Religare informed the exchanges that the Enforcement Directorate conducted searches at several premises linked to senior officials of the company. Vivek, you've been following this very closely. What do you have for us?
Well, quite a lot has happened, especially in the last week. So first thing, what's actually happened is that the Enforcement Directorate went ahead and conducted searches at the premises of all the key managerial personnel of Religare Enterprises. That includes Dr. Rashmi Saluja, the Executive Chairperson, the Group CFO, the General Counsel, as well as the Chief Operating Officer. So while there were no findings from the ED, what actually happened is that the ED has gone ahead and frozen the ESOP shares that were issued of Care Health that were issued to Dr. Rashmi Saluja, and now she cannot do any further dealings on that. Now remember, the most important thing as far as markets are concerned is what exactly is the status of the open offer. Now remember, June 2024, SEBI had gone ahead and issued a 12-page show cause notice to Religare board and to the chairperson Saluja as well, and they had directed both the board as well as chairperson Saluja to go ahead and give an undertaking to file an application for the open offer with all of the regulators. Newspaper reports indicate that the company has gone ahead and submitted all of the documents required for the open offer to proceed, and this was done on August 6, 2024. Now, coming to another key point, that is Care ESOPs. Now, Care ESOPs, remember, the SAT had gone ahead and stayed the IRDAI order cancelling allocation of Care ESOPs to Rashmi Saluja. So now basically, however, what SAT also did was that they went ahead and ensured that there would be no further dealings or no further allocation of the ESOPs of Care. Remember, Care Health Insurance, one of the key earning parts as far as Religare is concerned, and Care also was in the IPO route some time ago. Lot of uncertainty still prevails, but at this point of time, the open offer will be moving forward because the company has gone ahead and filed with the exchanges, and also regulatory concerns mount as far as the existing board is concerned.
Interesting. Thanks a lot for that update, Vivek, because the stock also now is 4% lower, almost at the lowest point of the day. And moving on then from a stock that is not having a very good day to a stock that is having a very good day, and that is NIIT. We highlighted earlier in the show as well. The stock is in an upper circuit of 20% after Ramesh Damani bought 8 lakh shares in the block deal that happened on Friday. Rima is joining in with more details. Rima.
Thanks so much for that. Big mover today. NIIT Limited, as you pointed out, Ramesh Damani, marquee investor, has bought 8 lakh shares last week at a price of 127. That's about 0.6% of the equity. But he's not the only large investor in the company. You also have Nippon Small Cap Fund with an 8% holding. Marathon Edge has holding. MIT has close to about a 5% holding. Now, just to give a sense about the fundamentals of this company. Now, in July, the company has guided that in Q2, they will see a top-line growth similar to Q1, which is 10% on a quarter-on-quarter basis. But the company is making investments, and therefore margins in Q2 could be negative. They're talking about single-digit margins at this point, though they will turn positive in Q3 and Q4, and therefore for the full year, the company is guiding for a top-line growth of 380 to 400 crore rupees with low single-digit margins.
Thank you so much for that, Rima. NIIT today locked in the upper circuit. One particular stock, especially in the last 5-7 minutes of trade, that's seen quite a bit of a dip is Paytm, 197 communication. We'll stand by if there's any developments on the same, but if you look at the intraday chart of Paytm, this particular stock is down quite sharply, almost 4% lower. But that's all the time we have on this edition of Midcap Radar. Your stocks when we return.